This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and our personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today is episode number 24. Today's episode is titled, How Much Is It Worth? You know, that question, if I could be sincere and honest as possible, is probably one of the very first questions that I field whenever I start working with a new client. Perhaps you're wondering what your business is worth. I know I've asked that question. I've heard people ask it all the time. Well, Justin, how much is my business worth? You know, the truth of the matter is the business is worth what someone is willing to pay for it. That's a simple answer. But that's also a cop-out, as my dad would say. Justin, that's a cop-out answer. Let's break it down a little bit. So today I want to talk about how much is your business worth? We're getting to the point now in the sales process where we need to know, or at least need to know the methodology for this particular concept. So I'm going to use an example that happened in my life as a foundation for comparison, like I often do. I always try to compare finances to something that we deal with outside of finances because it helps me in my mind to break things down. So in 2012, my wife and I wanted to sell our house. We had grown tired of suburbia and we wanted to move to the country. I mean, this was the big move, right? I dreamed of living on a farm, having a tractor, right? Being able to drive a tractor and eat pizza. Giddy up. Now, my wife, not so much. My wife grew up in the city in Knoxville, Tennessee, or as they say here, Knoxville, Tennessee. She had never dealt with country living. I mean, she had never lived more than 5 minutes away from a grocery store. She could ride her bike to a grocery store if she had to. Me, not so much. I like to be able to walk outside and not hear anything. I don't like the sounds of the city. That's all she had ever heard. I like to walk outside and not hear anything, look up at the stars and see God's wonderful creation. She'd never seen the stars. She could only see the city lights. Now, granted, Knoxville is not like Chicago or New York or some of those other metropolitan areas, but nonetheless, it wasn't the country, folks. So we decided to sell the house. She had had enough of it and she wanted to play with some chickens. So here we went. We're getting ready to sell the house. And so we schedule a meeting with the realtor. The realtor comes over to the house and we sit down. The realtor I've known for years, good friend of mine, and she knew how to handle my personality. She's very tactical in her presentation, and we knew we were going to work with her because this is the realtor we're going to hire. She already had the listing paperwork ready, drawn up, and she sits down and she says, well, how much are we going to sell the house for? Now, I was ready for that question, right? I knew how much my house was worth. So I gave her a number. And my realtor friend, she's sitting there and she looks at me and she says, yeah, I don't think so. And I said, oh, really? And she told me a price. And it's like a gunshot went off in my ear. And all I heard was ringing. It's just loud ringing. And after I picked myself up off the floor, I'm like, what? And she said, yeah, that's how much we can sell your house for. And I'm like, that's like 20 grand less than I paid for the house before I finished out the basement and I listed out all the things that I had done to the house. And I'll never forget what she said next. To this day, in fact, this exact quote, she said, while that may be true, you will never sell it for more than this price in this current market. And you know what? She was right. We actually sat there at that location for some 3 years, and we allowed the market to recover so that we could break even on the house. But like many business owners, I thought my house, or a segue to a business, was worth more than it actually was. So to attempt to keep your blood pressure down and not fall out of a chair whenever you find out how much your business is worth, let's understand the methodology behind business valuations. In just about any sales process, there are 3 ways to value a product. Before I share these 3 ways, let me go ahead and tell you at the very end of this podcast, I'm going to give you a link to a business assessment tool that will give you it's not a valuation per se, but it'll give you an idea on what your business could be worth. And I'll also show you some weaknesses that you may have in your business and some areas that you need to strengthen up a little bit. So stay tuned to the end when we're going to give you that link on how to get this complimentary business assessment tool. Okay, back to it. So there are 3 ways to value a product. The first one is the replacement cost. Replacement cost is what it says it is. So at the time when I was getting ready to list my house, the price that a buyer would have to pay for my house, if I agreed to the price, would be far less than if they were trying to build a house right beside it. That's not uncommon, depending on where you're at in the country. So insurance, for example, even the insurance benefit was significantly higher than the house would sell for. So if the house burned down, if I had to replace it, it was going to cost a lot more than what the buyer could pay for it at that particular time. That is what's called replacement costs. Now, in business, the number can be a little bit more subjective, okay? A buyer will often look at your business. If they're using a replacement cost methodology, they'll look at your business and the items of your business, and they'll do a mental calculation or sometimes a computer calculation onto how much it would cost to replace your business. So let's say it's a manufacturing company. A potential buyer will come in and they'll look at your equipment that you have. They'll look at how much does it cost to replicate the systems. But if I had to hire these same individuals that we're currently working with, how much would it cost me to hire these people? How much marketing dollars do I have to spend to go out and gain the same clientele that this manufacturing business already has? And many times, replacement cost is higher than what the purchase price could be. Now, replacement cost is mainly used, though, in an asset sale. So, for example, I've got a client of mine who has a lot of equipment, and if he ever sells his business, it's going to be basically just selling the equipment out. There's a little bit of goodwill, but it's mostly just an asset replacement. So there's a value that's placed on this piece of equipment, on how much, if a bulldozer were to burn, how much would it cost me to go out and replace the exact same bulldozer with the exact same wear and tear, the exact same number of hours, the exact same tread left on the tracks. That's replacement value. More than likely, that's not going to be used in your business valuation, but it could be. The second type of business valuation that's used is what's called a comparable value. So when the realtor dropped the bomb on my dreams that we're going to sell the house back in 2012, she was prepared for my questions because I thought I saw stars when she told me. I said, well, how do you figure? And she said, well, here's the houses which are similar to yours, which have sold in your regional or your geographic region. So she had prepared a list of houses that were real close, same bedroom, same square foot, same bath. I mean, real close, same size property. Maybe not everything identical, but it was pretty close. We already knew what people were paying for those houses, so therefore we could surmise what my house would sell for. Now, a comparable value or the comparable method is often used in franchises. You don't often use them in small independent businesses, but franchises is used often a lot. And the reason for franchise is because franchises are so similar. We can have a Subway in New York and a Subway in Texas, and it's going to be about the same cost of goods. It's going to be about the same everything. Maybe rent is a little different. Maybe salaries are a little different. But for the most part, it's pretty close because Subway's a Subway. A McDonald's is a McDonald's. A Jiffy Lube's a Jiffy Lube. Now, don't get too analytical. I know there's differences between each of those things. But hear me out. The franchises is where comparative method is often used. But not many times you use comparative value for the independent business. Instead, probably the most common method for placing a value on the business is an income method. Okay, this one's going to take some time to unpack this because there are so many different methods that can be used. But the way I look at it is the buyer is trying to obtain what the business is earning now and what the business will generate in terms of profit in the future. That's my financially simple explanation of the income method. Let's say that one more time. In the income method, the buyer is trying to obtain what the business is earning now and what the business is generating in terms of profits in the future, or what it could generate in terms of profit in the future. So let's take it back to my house. Now, if my house that I was selling was a rental property, in other words, it was producing income, a potential buyer might look at the monthly possible rent and multiply it by a number of 100. Or 150 or 200, depending on the locale nationally. So let's say that the rent is $1,000. They may take $1,000 a month in rent, multiply it by 100, and it could be a $100,000 valued house. Okay, that's a simple calculation. Now, there's many different calculations of the rental business. We'll deal with that as another date, but an income value, the buyer's often applying their own calculations, what I'm getting at, to generate a value. I've known some buyers who are willing to pay 60% of the rolling 12-month collections. So like in the self-employed doctor space, your dentists, your chiropractors, optometrists, veterinarians, I work with a ton of those individuals. I've helped many of them buy businesses. I have helped many sell businesses. I currently consult with many of those entrepreneur doctors right now. In fact, I'm almost finished with the editors on my first book ever. And that's going to be how a dentist can buy their own business. And many times they'll just take a factor and they'll say a business is worth 60% of the rolling 12 months. Yet I know other businesses which they're willing to pay 3.5 times net income. I've seen that calculation. And yet I've seen others who look at the future income. They'll say, hey, I'm trying to figure out how much money this thing's going to make over the next 5 years. And they'll surmise that or bring that back to a net present value calculation. That's another methodology. So an income method is more than likely what's going to be used by a buyer for the majority of businesses.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
Now, one of the most common methods for valuing the business starts with EBITDA. Now, if you remember, I've used this term a couple of times, and EBITDA is an acronym which stands for earnings before. So what the company makes before you deduct interest, taxes, depreciation, or amortization. And the reason why they go to EBITDA is because that's kind of like a good number that can equalize, if you will, businesses across multiple industries. And it's a fairly straight calculation, if you will. Anybody could do it. In fact, I did one this morning for a client who wants to buy a new business. I looked at it within literally 30 seconds, said, hey, this business is worth roughly this value, is how much I'd pay for it. I've had many clients who buy businesses based on the calculations. So let's say EBITDA, for example, is $500,000 and the factor is 3, or the factor is spoken as 3 times EBITDA. So if the EBITDA is $500,000, then the assessed value of this business would be worth $1.5 million. I've heard it said many times that the average is 5. I think that's more micro and macroeconomics. Many times people say, well, it's 5 times EBITDA is what I paid. Or I've recently seen in the M&A world that businesses have gone as high as 17, 18, 19 times EBITDA. And that's like, holy cow, that's a lot. Sometimes your business may only be worth 2 times EBITDA. So that's one way. Another way of using EBITDA, instead of calculating a factor method, is to use what's called a discount method. So this calculation starts with EBITDA and then looks at the potential earnings over the next few years. Then a net present value calculation is applied. So I once worked with a valuation expert in a legal case, and this is what the method was used. But basically, he used this to try to figure out a loss caused by the opposing party. And the expert took the cash flow from the previous 3 years. And so let's say that's $100,000 average for the last 3 years. He then added a growth factor of, let's say, 10%, and that's a subjective term. And that gave us the income per year over the next 5 years. So let's just keep this super simple. If let's say he had $100,000 and had no income. So over 5 years, the business was produced $500,000. He then ran a net present value calculation to today and said, well, what is $500,000? How much would I need today earning 4, 5, 6% interest, whatever the value is, in order to have $500,000 over the next 5 years? So that's called a net present value calculation. Is using income the only way to generate value? No. So where I'm getting at here is I'm going to try to transition into, what causes the value of the business to increase? If EBITDA is the foundational point, is income the only way? No, not at all. Not at all. It's just the starting point. So if you go back and listen to episodes 2, 3, 4, and 5, I think it was, I dealt with many additional items that would drastically impact the value of your company. This is not everything we cover, but you'll remember these pretty easily. So one of the first ways which helps increase the value of your company is that of increasing revenues. Or another way to say it is a company that's growing in revenue year after year. And that'll drive the value of your business higher. See, buyers want to see a company which is in a growth pattern. All right. If a business is losing income, unless it can be easily explained, buyers get kind of shaky. So let's say that the company had a lower EBITDA in years 2 and 4 than it did in years 1, 3, and 5. Well, this company who had a good income in 1, lower income in 2, good income in 3, lower income in 4, and good income in 5 is not going to bring as high as a sales price, more than likely, as a company which had year after year, the income is increasing. So for example, the year number 2, income was higher than year number 1, and year number 3 income was higher than year number 2, and so forth, so on. Increasing income is going to help drive the value of your company. So at this point, ask the question, how is your income in your company? I've actually have clients who are preparing to sell their business, which when we look at their revenue stream, just because of collections or whatever, it looks like that the company was not going to collect or produce as much income in, let's say, 2017 as it did 16. So we get all hands on deck in October, November, December and start trying to push for a collection so that now when the potential buyer looks at the tax returns, they can see that year after year the company is producing revenue. For whatever reason we try to move it away or explain it away, we don't want to see the company's income or the company's revenue drop from year after year. So by now you're probably thinking, Justin, isn't there an easier way to get a value on the company? Well, yeah, there is. But before we jump into that, let's deal with a couple of the other things that I dealt with. Go back in the episodes on the competitive advantage. Listen to scalability. Listen to the strength of your bench. Each of those will help you. And yes, there is an easier way to get a value of your company. Obviously, the answer is yes. How would you do it, Justin? How would you figure out a rough value of your company? Well, there's 2 ways you can go. Number 1, you could use a benchmarking tool. The internet's littered with them. You can enter in some data and try to get a rough value. I'd be cautious in that. I personally have played with these tools, and having sold 3 businesses, I know that they can be extremely misleading. The easiest way I'm going to tell you is, especially if you're getting ready to sell a business, you're going to have to hire an expert. So this is a person which provides you a formal estimate or a formal value or a valuation on your company. And this expert's probably going to hold the credential of the Certified Valuation Analyst. And they acronym that out to a CVA, or Charlie Victor Alpha. So CVA. Now, these individuals who hold the CVA also potentially hold the CPA, or Certified Public Accountant. Now, you're like, Justin, I already have a CPA. Can't I just have my Certified Public Accountant provide me a value as to my business? You know, much like there are different flavors, if you will, of doctors that have different specialties, in the finance world, there's different flavors. And more than likely, your personal and business certified public accountant, which helps you in your tax planning, is probably not adequately prepared to provide you a formal business valuation for the transition of your business, more than likely. Now, there are some CPAs which do hold CVAs, or Certified Valuation Advisor designations, but it's been my experience that you want the expert. You want somebody who, when the opposing team, the buyer, if you will, wants to look at questioning the value of the business, I found it best, especially if you're dealing with the biggest asset of your life, to hire the best. You want someone that whenever they speak, the opposing team or party in this case listens and respects their advice. Now, they may not agree with it, but at least they can give them pause, and potentially you can end up getting the price higher. I'll give you a case in point. This actually happened. I had a young dentist who wanted to buy a business, and as I mentioned earlier, many times dental practices will sell, just as a rule of thumb, for 60% of 12-month collections, or maybe 70% of 12-month collections. Sometimes lower, sometimes higher, but that's a rough rule of thumb that you can use in dental offices around the Southeast. The buyer in this case had hired some bigwig, and this guy was well documented. He had a nice business valuation put together, and whenever I saw it, and the expert that my client had hired, I looked at it and said, I don't think the business is worth this. And every time I end up coming back to the point, the buyer had their mind inundated with that is the price because so-and-so says it. Now, we ultimately didn't buy the business, but that's the here nor there. My point is this. If you have a big hitting valuation expert on your side, it will affect the buyer. Now, is it going to get you where you want to be? No, not at all. So to me, if you're entering the point of business where you're going to sell it, go ahead and hire an expert, a certified valuation analyst. This person's just going to come in for one play. This is a special teams player here, folks. They're going to come in for one play, and that is to provide you a value and to try to convince the other side what the value is. You know, another way to get it is through benchmarking software, as I mentioned. Now, as a certified exit planning advisor, which is someone who quarterbacks the sale of a business, I have all my business clients complete a 10-minute assessment. Now, this isn't a formal valuation. You can't take this to court. You can't even take it to the other side. But what it does, it provides you a rough value of your business. And this is what I was mentioning earlier. Not only will it provide you a rough value, but it'll also give you some insight in the areas of your particular business which you could work on, which will cause your value to potentially increase or go higher in value. And I'm making this complimentary confidential assessment accessible to you, my listeners. I've never done this before. I've never offered it out. Typically, I work with clients only on this, but you're welcome to use it. If you go to my financiallysimple.com/readiness, so financiallysimple.com/readiness, you'll go right to the assessment. And what the assessment is going to do is ask you very similar questions to that of a formal business valuation. Not to the degree. By no means is this a valuation. You hear me loud and clear. This is not a valuation. This is just an assessment. But go there and check out my blog, financiallysimple.com/readiness, and you'll get an idea on the process of going through and getting a value. So, guys, I'm going to wrap it up with that. I can't wait till next episode. You'll have to come back. It's going to be awesome. I've been working on those. I'm going to record it here for too long. I'm getting excited about it. But, guys, that's it for this episode. So how much is your business worth? I don't know. But there are some ways you can find out. And if it's not what you want the business to be worth, now's the time, folks. Get hopping. Let's increase the value. After all, this is more than likely your biggest asset. Let's make our businesses worth millions. So, guys, as I always say as a wrap up, life is hard, life is fun, life is complicated, money definitely doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and create an outstanding day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.